Welcome to this month's update of our Chronicle of a Real Money ASX stocks portfolio. This is where we put it all out there, warts and all, so you can see exactly what investing following a systemized mechanical process is all about and why it works long term. The great thing about telling a story of a real money portfolio that's been transparently watched by our members from the beginning is that there's nowhere to hide. We all walk the path together in real time and learn from those experiences as we go along. And now you can too through this YouTube channel and follow the journey as it happens. You may have also seen some of the videos of the individual trades that we've taken with both winning and losing trades from this portfolio to see what the day-to-day experiences is all about. Now, in these monthly performance updates, I'm going to benchmark against the ASX200 Accumulation Index. If you're not familiar with it, the ASX200 Accumulation Index is an index that follows the largest 200 Australian listed companies and their performance as a whole, and also includes their dividends along the way. This slightly outperforms an ASX 200 index fund or ETF like STW with dividends included due to the fees that they charge for holding them along the way. This slightly outperforms an ASX 200 index fund or an ETF like STW when you include their dividends due to the fees that they charge for holding them. However, the bulk of retirement savings invested in super funds or pension funds are invested in balance funds, like around 70 or 80% of them. While benchmarking this real money portfolio performance against balance fund is not quite an apples for apples comparison, it is valid for those who are considering taking more control for themselves with an active approach, rather than just leaving all their retirement savings in an average managed fund or a super fund. Now, because I get a little tongue-tied saying ASX 200 Accumulation Index all the time, I'm just going to refer to it as the market or accumulation index as we go along. I hope that's okay with you. Okay, so let's get into the performance update. Firstly, let's look at the most recent monthly percentage return of our public portfolio compared to the accumulation index. Did it beat the market? Was it the best month that it's had in years? Well, actually, no, it wasn't. But that doesn't faze us or our members, and I'll explain why. In the month of July, we can see that our public portfolio is up slightly by 0.74%, and the accumulation index was up 2.88%. So overall, the market did a little bit better than our portfolio in July by a small amount. I showed the loss trade on Northern Star Resources in a recent video that likely caused some of that slight underperformance. Rather than sticking around and hoping it'll just turn around on some positive news that may never come, we'll happily cut a loss and move on to something that is showing better potential at the time. And that's really the idea, moving your money to the areas of the market that are performing at any given time. If something starts to fall away, you get out and you buy something with a greater probability of growth in the meantime. You want your money to work harder for you and have it in the areas of the market that are outperforming at any given time. And of course, while you can't time it perfectly on every trade for 100% winners all the time, you can stack the odds in your favor over the longer term. Okay, so some of the news events that have had an impact on the market over the past month are the reduction to inflation, which is good news, the removal of RBA Governor Philip Lowe, oil and gas prices are both up, and retail sales have declined. Funnily enough, though, shares in both Harvey Norman and JB Hi-Fi were up in July, despite retail sales being under pressure. As we said before, you can't expect the market to react the way you think it might after the news comes out. Often it does the complete opposite, leaving investors scratching their heads a little bit to wondering why it happened. Of course, anything can happen, and it often does in the markets. So let us know in the comments below some of the highlights and lowlights that you've had yourselves in the market over the past couple of months. We'd love to hear what you've been up to so that others can learn from your experiences too. Now, as I mentioned before, we don't get fazed or excited over any short-term results or short-term news of the day because we know that a small sample won't make or break your portfolio over the long term. It's really only a small snapshot in time in the big overall scheme of things. What we're more focused on is how the positive mathematical edge built into the system plays out over the longer term and making sure that our portfolios are profitable over time. Rome wasn't built in a day, and your portfolio shouldn't be built in a day either. It's not about making $1 million overnight, as much as we would like that to be the case. It's a process that takes time, one that needs a structured plan to do it successfully, and then a consistent routine that you can maintain on an ongoing basis. So if we look at the slightly bigger picture, more than just 1 month, by following such a systemized process, we can see that our annualized return over the past year was 10.44% compared to the market that was 11.6%. That's from the end of July 2022 until the end of July 2023. Then as time goes on, the story really starts to unfold. This is what we talk about with an edge playing out over time and making a big difference to the growth of your portfolio. In 4 years, our real money portfolio has grown 45.17% compared to the market at only 25.99%. That's a big difference. In that time, we also have the COVID crash, where many people had to watch their portfolio fall 30% or more because they didn't have a strategy to get themselves out. You can see on the chart here where our portfolio did see some drawdown, but moved quickly to cash by selling out, protecting against the majority of the fall that occurred. Whereas the market, it got smashed, taking so many investors with it as it fell that 35%. Importantly, though, because our members hadn't lost their shirt on the way down, they had more money to invest when the market did pick up. So their portfolio could move forward much, much quicker rather than trying to play that big game of catch up after a crash. Of course, when we go all the way back to inception to the beginning of 2016, we can see the really big picture. The portfolio has grown 157.94% compared to the market that's only grown 89% over that same period of time. As time goes on, the gap just gets wider and wider because we've got more money to invest and can therefore grow the actual size of the portfolio at a much greater level, compounding profits on top of profits on top of profits. And when the market crashes again sometime in the future, which it will, our members will get out and protect rather than going down with the ship, just like they did through COVID, leaving them more money in their pocket to invest going forward. It makes investing much less emotional and stress-free while helping you grow your portfolio at a much greater rate. That's why our members choose to approach the market in this way. It's about running a sustainable portfolio in a consistent manner to grow your money much more over the long term. So if you have an interest in seeing how we do it and would like to take a run through the system with me personally, feel free to give us a call, send an email, or book in a Zoom chat and I can take you through it. And of course, if you want to keep up to date with all the new positions that we've bought in our portfolio or the ones that we've sold off and learn all the ins and outs about trading the stock market with a system, then subscribe to the channel and tap the bell to get notifications of all the latest. And as always, this video is of course for education purposes only and shouldn't be taken as specific advice as to which stocks to buy, hold or sell in the market. And that past performance is not a guarantee of future performance. But until next time, where we look forward to showing you around the markets again, I wish you consistent and objective investing. Bye for now.